We are watching the U.S. stock market right now, and what is unfolding on these screens is significant. The S&P 500 is under pressure, major stocks are dropping, and investors across the country are asking the same question at this very moment. What is happening? Why is it happening? And how bad does this get from here? We are going to answer all of that right now, in real time, with the actual numbers that are moving markets as we speak. Let's go. The S&P 500 is down. We are watching the index trade in the 5,200 range after having shed close to 11% in just the first 8 days of this April sell-off alone. That is not a slow bleed. That is a sharp, fast, aggressive move to the downside that is catching investors off guard. The Dow Jones Industrial Average is off sharply as well. We are looking at a Dow that has lost more than 4,000 points across just 2 trading sessions at the peak of this selling. That kind of 2-day point loss is not something you see often. This is a major move. The NASDAQ Composite, which is your technology-heavy index, has dropped into bear market territory. That is defined as a decline of more than 20% from its recent peak. The NASDAQ is officially in a bear market right now. The Russell 2000, which tracks small-cap U.S. companies, is getting hit the hardest in percentage terms. We are seeing the Russell 2000 down 6.59% in a single session at the depths of this sell-off. Small caps are leading the losses across every major index. That matters, and we are going to explain exactly why in just a moment. And the VIX, the volatility index, which traders call the market's fear gauge, has spiked sharply above 30. A VIX above 30 is the market's way of saying that uncertainty is extreme. It is the options market pricing in rapid, unpredictable swings. Historically, readings at this level coincide with major market crises. The VIX is flashing a signal right now that every investor needs to take seriously. These are the numbers. This is what is on the screen right now, and we are just getting started with the breakdown of why this is happening. Here is the direct cause of what you are watching unfold in the market right now. On April 2nd, 2025, a date already being called Liberation Day, President Trump announced sweeping tariffs on nearly all U.S. imports. These were not targeted, surgical tariffs on specific goods from specific countries. These were broad, sweeping tariffs that apply across the board, starting at a minimum of 10% on all imports into the United States. Markets were not prepared for the scale of this. Analysts had been modeling scenarios, but the actual announcement came in far more aggressive than most expectations, and markets reacted immediately and violently. Here is the direct market impact in the days that followed. April 3rd, the S&P 500 drops 4.84% in a single session. The Dow Jones falls 1,679 points, a 3.98% decline in one day. The NASDAQ Composite drops 1,600 points, down approximately 4.84% in that session alone. The Russell 2000 leads all losses at 6.59%. April 4th, it gets worse. China retaliates. Beijing announces 34% counter tariffs on U.S. goods, and markets respond. The Dow drops another 2,231 points, down 5.5% in a single session. The S&P 500 falls 5.97%. The NASDAQ drops 5.8% and officially crosses into bear market territory. In just 2 trading days, April 3rd and April 4th, the S&P 500 loses approximately 10% of its value. The Dow sheds more than 4,000 points combined across those 2 sessions. And in total, the 4-day window following Liberation Day erases approximately $5.83 trillion in S&P 500 market value. That is the steepest 4-day loss in the history of the S&P 500 index. Let that number sit for a moment. $5.83 trillion gone from the market in 4 days. To give that context, that is a loss comparable in scale to major historic crashes. Analysts and market historians are drawing comparisons to 1929's Black Tuesday and the 2008 Lehman collapse in terms of the severity and speed of the move. This is not hyperbole. This is what the data is showing us right now. All right, the tariff math, what these numbers actually mean. Let's get specific on the tariff numbers because this is critical for understanding what is hitting corporate America right now. UBS, one of the largest investment banks in the world, has run the math on the current effective U.S. tariff rate. Here is what they are reporting. The overall U.S. effective tariff rate is now sitting at approximately 27%. Before April 2nd, that number was approximately 9%. That is a tripling of the effective tariff rate on U.S. imports in a matter of days. Specifically on Chinese imports, the U.S. is now imposing 145% tariffs. That number started at 125% when it was first posted on social media by the White House and was then clarified upward to 145%. China's retaliatory tariffs on U.S. goods currently stand at 34%. We are watching the two largest economies in the world engage in an escalating trade war in real time, and the markets are pricing that in right now. Even excluding China entirely, UBS estimates the effective U.S. tariff rate on the rest of the world sits at approximately 11%. That is still a dramatic shift from the relatively open trade environment that existed just weeks ago. Companies that built their entire cost structure, supply chains, and profit margins around a 9% effective tariff rate are now operating in a fundamentally different reality, and they are repricing that reality right now. Now, here is an important development that happened in the middle of all of this that you need to understand, because it tells you a great deal about how fragile and reactive this market is right now. On April 9th, just days into the crash, the White House announced a 90-day pause on the reciprocal tariffs for most countries, reducing them back to 10% for the pause period. China was explicitly excluded from that pause. The market's reaction was immediate and historic. The S&P 500 surged 9.5% in a single session on that announcement. That is the third best single day for the S&P 500 since 1940. The Dow Jones gained nearly 3,000 points in that session, a gain of 7.9%. The Nasdaq jumped 12.2% in a single day. And then the very next session, April 10th, the market gave back 3.5%. The S&P 500 dropped 189 points to close at 5,268. Why? Because the White House clarified that the 145% tariffs on Chinese imports were still fully in effect. China announced further countermeasures, and the brief euphoria evaporated almost instantly. What this is telling us is that this market is on a hair trigger right now. Any headline, any tweet, any press briefing, any clarification from any official is capable of moving this market by several percent in either direction within hours. That kind of sensitivity is the direct result of policy uncertainty that the market simply cannot price with any confidence. And the VIX above 30 is reflecting exactly that. Let's go sector by sector and stock by stock, because this sell-off is not hitting everything equally. There are clear fault lines in this market, and you need to know where they are. Energy, the worst performing sector right now. The energy sector is down 13.86% for this period. That is the single largest sector decline in this sell-off. Oil prices are falling sharply. U.S. crude oil is off more than 3% in recent sessions, as global demand fears mount and OPEC Plus increases production simultaneously. Chevron, one of the Dow's major energy components, is down approximately 18.67%. Energy stocks like APA Corp and Devon Energy are among the biggest individual losers in the entire S&P 500 in the period following the Liberation Day tariff announcement. If you have energy exposure right now, you are feeling this acutely. Healthcare, under significant pressure. The healthcare sector is down approximately 3.7% to 3.8% in this period. United Health Group, one of the largest companies in the healthcare space, is a significant drag here after missing earnings and cutting profit guidance. When the largest company in a sector stumbles, it pulls the entire sector with it, and that is exactly what is happening in healthcare right now. Financials, real estate, materials, all posting negative returns in this environment. Recession fears are driving selling across rate-sensitive sectors. When GDP is contracting, and we just saw a first-quarter GDP contraction of 0.3%, sectors tied to economic growth face an immediate repricing. Consumer discretionary, under pressure for a very direct reason. Tariffs raise the cost of goods. When goods cost more and consumer sentiment is falling, and right now, consumer sentiment is at record lows, the companies that depend on Americans buying things they want rather than things they need face a double headwind. They are getting hit from both the cost side and the demand side simultaneously. Now, here is the one sector that is not falling right now, and this is notable. Technology, actually posting gains in April overall. The technology sector is up approximately 1.69% for the month, despite everything else that is happening. Here is why. The White House's tariff pause specifically exempted electronics from the highest tariff rates. Smartphones, computers, chips, those exemptions provided a direct relief valve for the tech sector. Stocks like Nvidia, Broadcom, and Amazon are among the names holding up and in some cases rallying even as the broader market sells off. But, and this is critical, we need to look underneath those tech gains, because what we are seeing in terms of market breadth is alarming. On certain sessions, only 15 of the top 100 stocks in the S&P 500 are advancing, while 86 are declining. The index is being held up by a very small number of very large technology names. That is not broad market strength, that is concentration risk. And when the names propping up the index face their own headwinds, and they will if trade war pressure reaches their supply chains, there is no broad base underneath them to absorb the impact. This is a development that is getting significant attention in trading rooms right now and needs to be on your radar. U.S. Treasury bonds, historically the safest asset in the world, the thing investors run to when equity markets get scary, are also selling off. Investors are dumping U.S. Treasuries alongside stocks. That is not normal. In a typical risk-off environment, investors sell stocks and buy bonds, which pushes bond prices up and yields down. What we are seeing right now is both stocks and bonds selling simultaneously. That is a signal that confidence in the U.S. financial system itself is being questioned at the margins, not just confidence in specific stocks. When you see simultaneous selling of U.S. equities and U.S. Treasuries, it typically points to foreign investors reducing their U.S. exposure broadly. That is the interpretation that is gaining traction right now among analysts. Capital is moving. Some of it is rotating into European equities, some of it is going into Asian markets, and some of it is going directly into gold, which is reflecting that capital flight right now, with gold approaching and exceeding record highs. The dollar is weakening alongside this. A weaker dollar, a selling bond market, a falling equity market, these are not independent signals. They are telling a connected story about reduced confidence in the U.S. as a safe haven destination for global capital in this specific moment. That is the headline from the bond market right now, and it is one that every equity investor needs to be watching. Let's talk about recession risk, because it is front and center in every conversation happening on trading floors right now. First quarter GDP for 2025 came in at negative 0.3%. That is a contraction, not a slowdown, an actual contraction in U.S. economic output. That is the first data point. The second data point is that recession probability estimates among major Wall Street firms have doubled in recent weeks. J.P. Morgan's analysis puts the odds of a U.S. recession at approximately 40% right now. Some firms are going higher than that. CEO surveys are showing that approximately 80% of chief executives are currently expecting a recession. Consumer sentiment is at record lows right now. That matters because consumer spending is approximately 70% of U.S. GDP. When consumers feel economically insecure, when they are watching their 401ks drop, when they are reading about tariffs raising prices on everyday goods, they pull back on spending. And when spending contracts in an economy that runs on consumer spending, the effects show up in corporate revenue and earnings fairly quickly. At the same time, inflation expectations are running hot. Long-term inflation expectations hit their highest level since 1995 during this period. Tariffs are by their nature inflationary. They raise the cost of imported goods, and those cost increases get passed through to consumers. The Federal Reserve is now in an extremely difficult position. They cannot cut interest rates aggressively to stimulate the economy and support the market without risking that they are pouring fuel on an inflation fire. And they cannot raise rates further to control inflation without potentially pushing an already contracting economy deeper into recession territory. The Fed is effectively caught between two bad options right now, and the market knows it, which is part of why the uncertainty premium built into this market, as reflected in that elevated VIX, is so high. Let's go directly to what market strategists and analysts are saying right now, because there are several important voices weighing in on this. Mark Hafley, the Global Chief Investment Officer at UBS, is explicitly flagging risks to global trade from the current US-China escalation. UBS's analysis, the same analysis that gave us that 27% effective tariff rate figure, is pointing to significant disruption between the world's two largest economies as the core market risk right now. Stephen Innes of SPI Asset Management is describing the market environment right now as swinging between fear and euphoria, which is exactly what we have watched play out in real time. The 9.5% surge, followed immediately by a 3.5% drop in back-to-back sessions, is a textbook example of exactly that dynamic. JP Morgan has put out analysis describing the Liberation Day tariff event as one of the biggest macro shocks to hit markets in a very long time. Their note highlights 6 things that surprised even sophisticated investors about how this event unfolded, including the speed of the market reaction, the simultaneous selling of bonds and equities, and the scale of the China-specific tariff escalation. Morgan Stanley has been explicitly recommending that investors increase exposure to real assets, gold, commodities, alongside intermediate investment-grade bonds and international equities as ways to diversify away from the concentrated U.S. technology risk that is currently propping up the headline S&P 500 number, while most of the underlying stocks are declining. Here is where the money is moving in real time, and this is directly visible in the market data. Gold is hitting record highs. This is a direct flight to safety trade happening in real time. When investors get this uncertain about the direction of equities, and even bonds, gold historically attracts capital. That is exactly what is happening right now. Consumer staples is outperforming everything in the equity market right now, posting gains of approximately 1.2% while everything around it falls. Consumer staples, companies that sell food, household products, basic necessities, are the classic defensive play in any risk-off environment. Money is rotating into these names right now because their revenue is less sensitive to economic cycles, and their products don't disappear from shopping carts when people get nervous. International equities are attracting capital flows. European markets and certain Asian markets are seeing inflows from investors, reducing their U.S. equity exposure. This is directly visible in the dollar weakness we mentioned earlier. Capital flowing out of U.S. dollar-denominated assets into foreign markets shows up as downward pressure on the dollar. That is what is happening. Short-duration, investment-grade bonds are seeing demand even as longer-dated treasuries face selling pressure. Investors are looking for relative safety with some yield while keeping duration short given the inflation uncertainty. What all of this tells you is that sophisticated institutional money is repositioning right now, not panicking, not going entirely to cash, but actively rotating out of the highest risk exposures, specifically the trade war exposed sectors and the overstretched small cap names, and into defensive positions that can hold value in a more uncertain environment. We are going to give you the exact variables that will determine what this market does from here. These are the 3 things every investor needs to have on their screen right now. Number 1, tariff negotiations and any escalation or de-escalation with China. This is the single most important variable in this market right now. The 90-day tariff pause for most countries is in effect, but China is explicitly excluded at 145% tariffs. Any signal of U.S.-China negotiation, any back-channel communication, any diplomatic development has the potential to move this market by several percent instantly. We saw that with the 9.5% surge on the pause announcement. Conversely, any further escalation, any Chinese countermeasures beyond the current 34% retaliatory tariffs, any additional U.S. tariff increases will add significant downside pressure. Watch this development more closely than anything else right now. Number 2, Federal Reserve communications. The Fed is navigating the most complex policy environment in decades. Contracting GDP on one side, elevated inflation expectations on the other. Any signal from Fed officials about their current assessment of the balance between recession risk and inflation risk will move markets. Watch every Fed speaker appearance, every official statement, and especially any emergency communications. The market is pricing in significant uncertainty about the Fed's next move, and any clarity in either direction will be a major catalyst. Number 3, corporate earnings. We are moving into earnings season right now. This is the first earnings season where companies will be reporting under the new tariff reality. The numbers they report and, critically, the forward guidance they give will be the real-world data point on how much actual damage these tariffs are doing to corporate margins and revenue. Earnings that disappoint and guidance that gets cut will accelerate the selling. Earnings that show resilience and manageable tariff impact will provide relief. Watch the major reporters closely. Their guidance language around tariffs will be the most important thing in those calls, more important than the actual reported numbers. Let's be direct about this because this is ultimately why you are watching this report. If you have significant exposure to energy stocks right now, you are in the worst performing sector of this entire sell-off. Energy is down 13.86% for this period. Chevron is down 18.67%. APA Corp and Devon Energy are among the biggest individual losers in the S&P 500 in the post-Liberation Day period. The combination of falling oil prices and global demand fears means the near-term pressure on energy names is not likely to ease until we get either a tariff resolution or a meaningful shift in the oil supply picture. Neither of those is happening today. If you have exposure to small-cap U.S. stocks, the Russell 2000, you are dealing with a double headwind. Small-cap companies tend to have less pricing power and thinner margins than their large-cap counterparts, which means tariff cost increases hit them harder. And small caps tend to be more domestically focused on the revenue side, which means they benefit less from any dollar weakness, while still absorbing the full cost of tariff-driven input price increases. The Russell 2000 being the worst performer in the index universe right now is not random. It is a direct reflection of those structural vulnerabilities. If your portfolio looks like the S&P 500 broadly, your headline number may be masking more pain than the index suggests. Remember, right now, 86 of the top 100 S&P 500 stocks are declining on some sessions, while the index holds up because a small number of mega-cap tech names are carrying it. If your portfolio is diversified across the index, most of your individual positions are declining, even if the headline number tells a less alarming story. The investors who are best positioned right now are those with meaningful allocations to defensive sectors, consumer staples, healthcare selectively, utilities, alongside real assets like gold, and with reduced exposure to the trade war-exposed names in energy, materials, and global supply chain-dependent manufacturing. That is where the money is moving. That is what the sector rotation data is showing us in real time. Here is exactly where things stand as of this moment. The S&P 500 has lost approximately 10% in 2 sessions at the peak of this sell-off. $5.83 trillion in S&P 500 market value has been erased since Liberation Day. The Nasdaq is in official bear market territory. The Russell 2000 is leading all index losses. The VIX is above 30. The fear gauge is flashing a serious warning. Bonds and stocks are selling simultaneously, a rare and important signal. Gold is hitting record highs. The dollar is weakening. Consumer sentiment is at record lows. First quarter GDP contracted 0.3%. Recession probability estimates are at 40% and rising among major Wall Street firms. The Fed is caught between inflation and recession with no clean exit. The energy sector is the hardest hit, down 13.86%. Healthcare, financials, real estate, materials, and consumer discretionary are all under pressure. Technology is holding up due to electronics tariff exemptions, but market breadth is dangerously narrow. Most stocks in the index are falling even when the headline number looks stable. The tariff situation with China: 145% U.S. tariffs, 34% Chinese counter tariffs, is the core driver of all of this, and it is unresolved right now. There is a 90-day pause for most other countries at the 10% baseline rate, but China is fully excluded from that pause. The three things to watch going forward are tariff negotiations, Federal Reserve communications, and corporate earnings guidance. All three of those will be breaking in the days and weeks ahead, and every single one of them has the potential to move this market significantly in either direction. That is the market right now. That is what the data is showing. We are going to keep watching these numbers as they develop and bring you every significant move as it happens.
Stay with us.